What do you make of the bounce that we saw yesterday afternoon? Was that overdue after that pullback in the prior couple of weeks?
Well, good morning, Will. Basically, we did have a slight oversold situation, in my opinion, but probably more important was an important retracement level on the S&P 500 at about 3,900. So I think investors are saying, like, this is a line that we want to hold because the next level of support is down around 3,800, and then we go back to the June 16th low. So right now, the concern is whether we're headed for recession, and those are the sectors that are leading to the downside in terms of worries.
And do you think the worries are overdone? Do you think those June lows are very easily reached again?
I don't think they'll be easily reached, and I do believe that right now the feeling is that they will hold. We did retrace 50% of the decline on August 12th. And every time since World War II that we retraced 50% of a bear market move, we did not go on to set a lower low. So basically, the feeling is that right now we are likely to see the June 16th low challenged, but end up holding.
Sam, what do you say to people that point out the fact that you could look at something like the FTSE 100, where the dividend yield is over 5%, and the 10-year yield is about 3%, versus the S&P 500, where the dividend yield is less than 2%, but the 10-year yield has risen sharply, of course, year to date, and is about 3.2, 3.3%. Does that not suggest that U.S. equities are sharply overvalued?
Well, on a relative basis, I think international stock markets have been more attractive than U.S. for quite some time on a rolling 5-year compound annual growth basis, as well as looking at forward 12-month earnings. Both of these measures are at or below one standard deviation from the mean. And the problem is, however, that they have remained so for quite some time. I think basically investors are worried that because of the potential of a 75 basis point hike by the ECB, we, however, think it'll be 50 basis points. It's concerned that of the two regions, Europe is more likely to fall into a deeper recession than the U.S. So longer term, yes, international does represent a nice opportunity, especially should we see a weakening of the U.S. dollar down the road.
But even if you don't make the comparison Europe to the US, Sam, if you make it within the US, bonds to equities, that the scale in which yields have risen, the alternative to equities in the US over the course of this year, surely that could mean that US equities are due a much bigger pullback than they've had, even though they've fallen year to date.
Well, that's certainly a possibility, Will. I mean, when you look to the fact that the 10-year yield is now above what it was earlier in the year at 3.25%, heading to possibly 3.5% or further, based on the hints by the FOMC that they're likely to be terminating at about a 4% level for Fed funds. I think that certainly does put more pressure on the stock market. We have inflation that's more than 6.5%, and anytime we have had that since World War II, the U.S. has fallen into recession. And traditionally, we've seen very sharp pullbacks in valuations by about 1/3. So there is a possibility that we do end up lower. But I also believe that that's something that could end up being into next year when we have a greater likelihood of recession.